you're probably losing money without realizing it. Not because you're not smart, not because you don't save, but because your entire investment strategy might be riding on a single bet. And if that bet goes wrong, you could lose years of progress in a single market swing. The worst part? Most people don't even see it coming until it's too late. At the end of this video, you'll understand the concept that protects the wealth of billionaires, pension funds, and smart investors around the world. You'll learn what diversification actually is, why it's essential for any investor, and how you can apply it, even if you're just starting with a few $100s. Let's be clear, diversification isn't about spreading your money randomly. It's a method, a strategy, a defense mechanism. It's about designing a portfolio that can survive anything. Recessions, inflation, tech crashes, war, pandemics, interest rate hikes, whatever the world throws at you. When you diversify, you're not betting that everything will go up. You're building a plan that works even when some things go down. Picture this. In 2022, global markets were in chaos. The S&P 500 lost over 18%. Tech giants lost trillions in value. But oil and gas stocks soared. Commodities surged. Some bond categories provided stability while crypto collapsed. If all your money was in growth tech, you felt the pain. But if you had exposure to energy, value stocks, and cash, you absorbed the hit, maybe even stayed green. Diversification doesn't promise massive short-term gains. It promises resilience. The kind of resilience that keeps your wealth growing even when the world gets messy. Here's the truth. Nobody can predict the future. Not economists, not fund managers, not even AI. Markets are chaotic. Crashes are inevitable. Timing them perfectly? Almost impossible. So instead of trying to be right all the time, the smartest investors build portfolios that don't need to be right every time. They don't aim to win every battle. They aim to survive long enough to win the war. That's what diversification does. It limits the damage when you're wrong and keeps you in the game long enough to be right. It's not sexy, it's not dramatic, but it's one of the most powerful tools in long-term wealth building. So how does diversification actually work? It starts with a simple but powerful principle. Don't put all your eggs in one basket. But in investing, that means more than just owning a few different stocks. It means spreading your risk across different types of risk. Because not all investments respond the same way to economic changes, policy shifts, or global crises. Let's break it down. When the economy grows, stocks typically rise. But when inflation spikes or interest rates shoot up, stocks often fall while commodities or inflation-protected assets surge. When markets panic and uncertainty rises, investors rush to safety. That's when government bonds, gold, or even cash outperform. That's the core of diversification, owning things that don't move together. Smart investors mix multiple asset classes. Stocks for growth, bonds for stability, real estate for income and inflation protection, commodities for hedging risk, cash for flexibility, and sometimes alternatives like private equity, crypto, or hedge fund strategies for asymmetric returns. Each plays a different role in the portfolio. Think of them as gears in a machine. When one slows down, others pick up speed. But it goes even deeper. Diversification across industries is just as critical. If your portfolio is full of tech stocks, Apple, Microsoft, Nvidia, Google, you might feel diversified because you own different companies. But they're all exposed to the same sector dynamics. If tech gets hit, they all go down together. True diversification means spreading across sectors with different growth drivers. Healthcare, energy, consumer staples, utilities, financials, industrials. Some thrive in booms, others in busts. Some are defensive, others cyclical. Then there's geographic diversification. Many investors unknowingly fall into what's called home bias, investing mainly in companies from their own country. But global markets don't move in sync. US stocks had a phenomenal run in the 2010s. But before that, emerging markets were the stars. There are periods when Japan, Germany, or Brazil outperform the US. Investing globally spreads exposure to different economic cycles, currencies, political systems, and growth patterns. And don't forget time horizon diversification. Not all assets need to serve the same purpose. Some should grow slowly and steadily over 20 years. Others might be liquid in 6 months for a home down payment or an emergency fund. Some generate passive income, others focus on capital appreciation. Diversification even applies to strategy. Passive index investing, dividend growth, value, growth, momentum, factor-based, each one works under different conditions. Blending them can create a smoother experience. And here's the most important insight. Decades of research show that asset allocation accounts for more than 90% of your long-term portfolio returns. Stock picking, market timing, they matter much less than people think. Which means what kinds of assets you own matters far more than which specific stock you pick. The goal isn't to be perfect, it's to be prepared. Prepared for the good years and the bad ones. Because the markets will turn, always. And when they do, a diversified portfolio keeps you in the game. Now that you know what diversification is and why it matters, let's talk about something even more important. How do you actually do it? Because understanding the concept is great, but if you don't apply it correctly, you're still exposed to the same risks you were trying to avoid. The first thing you need is clarity. Clarity on your goals. Clarity on your timeline. Clarity on your risk tolerance. Are you investing for retirement 30 years from now? Saving to buy a home in the next 5? Looking for steady income in your 60s? Each of those goals demands a different mix of assets. There's no one-size-fits-all formula. A 22-year-old just starting out might build a portfolio that's 90% stocks and 10% bonds or cash. They have time on their side, and short-term volatility isn't a big concern. But someone closer to retirement might prefer 60% bonds, 30% stocks, and 10% real assets. Their priority is preserving what they've built. And that's the first rule of diversification. It starts with your personal context. Once your goals are clear, the next step is choosing your asset classes. Most well-diversified portfolios are built on 4 to 6 building blocks. Equities, domestic and international. Bonds, government and corporate, short and long term. Real estate, usually via REITs. Commodities like gold or oil. Cash or cash equivalents. And optionally, alternatives like crypto or private equity. The easiest way to access all this: low-cost ETFs and index funds. Let's say you build a simple 3-fund portfolio. 60% total global stock market. 30% total bond market. 10% real estate via REIT ETF. That's already more diversified than most portfolios out there. You're exposed to thousands of companies across continents, plus a stabilizing bond cushion, plus real asset exposure. If you want more depth, you can slice your equity portion. 40% US stocks. 20% international stocks. Or break it further. 10% emerging markets. 10% small caps. 10% dividend stocks. Each layer adds nuance, but also complexity. And that's where many people go wrong. They confuse diversification with diversification theater. Buying 20 ETFs that all track similar companies doesn't reduce your risk. It just gives you the illusion of control. Here's an example. You might own a tech ETF, a NASDAQ ETF, and a growth ETF. Sounds diversified, right? Until you check the holdings and realize they're all 30% weighted in Apple, Microsoft, and Nvidia. You're not diversified, you're concentrated without knowing it. That's why smart diversification means understanding correlation. You want assets that zig when others zag. When stocks fall, bonds may rise. When the dollar weakens, gold often strengthens. When the US economy slows, emerging markets might boom. It's that interplay, those differences, that reduce risk. And one more thing, rebalancing. Even a perfectly diversified portfolio drifts over time. Some assets grow faster, others shrink. That's why regular rebalancing every 6 to 12 months is essential. It brings your allocation back in line with your original plan. It forces you to sell high and buy low, automatically. No emotions, no predictions, just discipline. And that discipline compounds over years into something powerful. A portfolio that doesn't just grow, but endures. So let's bring it all together. Diversification is not about chasing the highest returns. It's about protecting your downside while still participating in long-term growth. It's not flashy, it doesn't make headlines. But it's what keeps real investors wealthy over decades, not just during bull markets. We cover the essence of diversification, spreading your risk across asset classes, industries, geographies, and time horizons, understanding correlations, avoiding concentration, and using low-cost tools like index funds to build a balanced, resilient portfolio. You don't need to be a financial expert. You don't need to time the market. You just need a strategy that works even when things go wrong. And that's exactly what diversification gives you. Most people lose money in the market because they bet on a single outcome. They go all in on one stock, one sector, one trend. And when that collapses, they're out. But diversified investors, they keep going. They absorb the shock. They live to fight another day. And that's the real secret, staying in the game long enough for compound interest to work its magic. Because wealth isn't built in 1 year, it's built in 10, 20, 30 years. And only those who manage risk wisely make it to the finish line. So take a moment and look at your portfolio. Ask yourself, am I really diversified, or am I just diversified on paper? Because the sooner you fix it, the stronger your financial foundation becomes. If you got value from this video, don't forget to like and subscribe. And if you want more strategies like this, check out our last video on the biggest investing mistakes to avoid. It ties perfectly with what you just learned. Drop a comment below if you want a breakdown of how to build a simple, diversified portfolio step by step. I'll make that video next. And remember, the best time to diversify was yesterday. The second best time is right now.